U.S. Federal Reserve Chair Jerome Powell reiterates his message at Jackson Hole, says the Fed will impose more large interest rate hikes in coming months and is resolutely focused on taming the highest inflation in 4 decades. Powell acknowledged that the Fed's continued tightening of credit will cause pain for many households and businesses as rates inch up. Following Fed's comment, bond yields resumed their upward trajectory. Now, let's dive deep into this. With me, I have Amit Tripathi, CIO Fixed Income Investments Nippon India Mutual Fund, who's joined us and who will help us figure out our investment in the debt portfolio and will also help us understand where will the yield curve move ahead, or how should you craft your fixed income investments. Amit, welcome to the show. Good evening. How aggressive you think is Fed's stand in taming inflation, and what do you think will be the cues for RBI going ahead?
Yeah, good evening. Thanks for having me. I think the pronouncement at Jackson Hole was slightly more hawkish than what the market was anticipating, although the market was preparing for it in a sense. Having said that, I guess since most of the global central banks had been behind the curve at the beginning of the rate hike cycle, they have been aggressive ever since, and the US Fed has led from the front. To our minds, if you actually look at the terminal rate expectations that are playing out in the US, those terminal repo rate expectations have moved up a bit, but not significantly higher. So you may look at a much more data-dependent Federal Reserve going forward. Near-term, more focus on inflation as far as at least this calendar year is concerned, and as we get into the next calendar year, becoming more and more data dependent in terms of further Fed fund movement, so to say. As far as the RBI is concerned, clearly on a relative basis, our growth inflation dynamics have been reasonably more balanced. Having said that, inflation has been an issue in India as well, and RBI has rightly reacted to it. I think since June onwards, the playbook has been fairly simple because RBI and markets have been broadly on the same page as far as inflation expectations and terminal repo rate expectations are concerned. Right now, the market is pricing in terminal repo rate expectations around 6%. Given the Fed stance and given the speech that we heard in Jackson Hole, the risk or the tail risk, so to say, is that would the RBI go beyond 6%, whether it's 6 quarter, 6 half, just to ensure that they don't fall back behind the curve vis-a-vis other global central banks, which is a tail risk. But broadly speaking, I think a 6% kind of a repo handle is something that is already priced in by the market.
Amit, a small explanation on bond yields, which I want you to help our viewers with. The 10 bond year yield and the new ones, which are slightly higher than the 10-year bond yields. Why? What is the reason behind that, and how should we, looking at it, how should we read between the lines when you talk about this difference in the yields?
No, I'm presuming you are asking between the old 10-year and the new 10-year. Is that what you asked?
The old ones and the new ones.
Yeah, no big difference. Broadly speaking, honestly, these are short-term market dynamics. Don't give too much of attention to that. This has more to do with near-term demand supply. The new 10-year gets supplied every week. The old 10-year supply has stopped. So there could be some difference of 5-7 basis points here and there from time to time, and this works both sides. It could also happen that the benchmark 10-year, which is being supplied right now, sometimes might have a lower yield given the higher liquidity premium that the market associates with it. So these things keep on changing, not more than 5-7 basis points either ways. We don't have to give too much of cognizance to that.
Now, talking about India's stand in terms of controlling inflation, now 6 months, coming 6 months, obviously in terms of demand outlook look really great as per the analysis of different experts and analysts coming on the channel. What do you sense now? How long you think this demand outlook is going to be strong? How long will it sustain if we consider all the geopolitical tension, specifically geopolitical tension and the recession in Eurozone that's obviously up there. How long do you think the dynamics, which is so far looking balanced between growth and inflation, will sustain?
First of all, as far as inflation is concerned, I think broadly the market has priced in what is to be expected. In fact, the market at one point in time was pricing in a much higher print FY23 inflation closer to 7%. That has since come down to 6.5% given the softness that we have seen in commodity prices and given some slowdown incrementally that we have seen owing to also expectations around a slowing global economy. So overall, inflation expectations for FY23 have actually come down in the last 3 to 4 months rather than going up. As far as growth inflation is concerned, truth be told, I think high frequency indicators in India at least are reasonably firm even as we speak. The services economy is doing well. The only chink in the armor, so to say, could be on the export side. We have seen some incremental slowdown there. And to the extent the exports contribute to the overall nominal GDP of the economy, you could see some impact playing out there. Uh, uh, so overall, if I were to look at the mix at this point and going forward, you could see some incremental softness in growth going forward, although not significant because domestic conditions still continue to remain pretty firm. And inflation, although higher than 6% for the year as a whole, in a better handle right now than what it was, say, 3 to 6 months back.
So in the current scenario, Amit, why is it that we look, liquid funds are looking much more attractive than fixed deposit rates?
So that's a slightly different argument in the sense that this is not about today. Historically, if you actually look at liquid funds and the carry that liquid funds have offered, they have typically offered carry above the repo rate at all points in time, broadly speaking. I'm not counting in here the early days post COVID because at that time there was a drastic cut in repo rate. The reverse repo rate had become operative and liquidity was more than 10 lakh crore. That was an abnormal scenario. But under normal scenarios, liquid funds continue to provide gross yields which are in excess of the repo rate. And that is typically not the case when you look at short-term FDs, which typically tend to provide yields which are below the repo rate. So there is a natural gap that always exists, I think, in a range of 50 to 75 basis points at all points in time across time periods, if you see. So that's not a big surprise, honestly. And the simple reason for that is that if you actually look at a typical portfolio of a liquid fund, you will have cash, treasury bills, certificate of deposits, commercial papers of up to 90 days, which tend to reflect current market yields, get mark to market on a daily basis, and reflect the extreme short end of the yield curve on a real time basis. So if you actually look at the current environment, for example, most of the liquid funds in the industry would be carrying a gross yield of around in a range of 5.5 to 5.75, which is actually above the repo rate, which is significantly higher than a similar tenor. For example, if you were to look at a 46 or a 90-day FD for retail investors, it would be significantly higher than what those FD rates are offering right now. This might be a slight anomaly given that markets are expecting a rate hike in October and hence pricing so rather end September and hence pricing that in as well. But in a general tendency also, if you look through the period, you will see that the basic difference of liquid funds tending to offer gross yields above the repo rate and short-term fixed deposits trending below the repo rate has been a consistent theme for almost the last 10, 15, 20 years that I can remember.
About fixed income, when you talk about debt category, what are the best options right now available to park your money for, say, short to medium term outlook?
Correct. So I think the good news is that the RBI and the markets are on the same page as far as inflation and potential terminal repo rate outlook is concerned. The tail risk comes in terms of what is happening in the broader international markets, the central bank reaction function, etc., for which you need to be prepared. So very important for investors, while on one hand, you don't take a 0-1 kind of a call in terms of being completely risk averse at this point, but at the same time, you be very, very careful about your investment horizon. So if your investment horizon is below 1 year, I would suggest that investors should stick to the ultra short-term category, which typically would invest in 6 to 12-month assets, and hence over that holding period, you will not have any negative surprises. But if your investment horizon is longer term, which is 1 year, 18 months, 3 years, and beyond, you should at least look at intermediate duration products such as the short-term bond fund, the banking PSU fund, etc. Unless you want a higher duration risk appetite, for which you can even look at gilt funds if your holding period horizons are 3 years and beyond. And this discomfort comes from the fact, like I said, is that the market has broadly priced in terms of potential rate hikes, and the yields are in a range where you would not expect too much of interim volatility going forward unless the ground realities change drastically from here. One other aspect that also can be looked at in this environment, a lot of target maturity products have come in the market in the last 3 years or so. Some investors who may want much higher visibility of returns can look at target maturity products suitable to their investment horizon, because there also the carry levels are now reasonably attractive compared to what was the case 18 months back.
Now, talking about fixed deposit rates, traditionally, how Indians love fixed deposits. Now we are in a rising rate scenario. Looking at this, when do you think banks would actually start transmitting this benefit to the consumers when you talk about deposit rates? Because it is slow. The pace is really slow, but eventually they will have to pass on the benefits on the deposits as well. When do you think this picking up? Because investors, although you recommended better options to invest and lock in their money, what if one really wants to park their money in fixed deposit? Should you wait? Should you just lock in your money on the current interest rates which are available?
Okay, so to answer that question, you are absolutely right. It's not a question of if but when. Now, the entire focus here has to be in terms of how efficiently you want to deploy your money. See, your credit to deposit ratio, the latest number is above 100%. Now that's an incremental number. Don't go too much by it. But the fact is that if you look at the overall CD ratio, also we are around 70 to 73% right now. We have seen this in very tight liquidity conditions to go to 75 to 78% as well. Deposits are growing at a slower pace than credit at this point in time, because traditionally deposit rates also have been slightly lesser competitive in the near past than what we have seen in the past. So you do hope to see these deposit rates moving up from here on. Maybe over the next 3 to 6 months, you will see these deposit rates going up from here on. Having said that, coming back to the first point that I made, that ultimately you're talking about efficiency, right? So if you actually look at the bank's deposit rate, which is the bank's borrowing rate, and the bank's lending rate, the gap between the two would hover anywhere between 1.5% to 3% at any point in time. You look at two cycles, you will notice the difference. What a product like a liquid fund or a money market fund actually does in that scenario is that we offer much superior efficiency in terms of cost. So because our intermediation costs are much lesser than that 1.5% to 3%, which we have seen in the last few years, we are able to pass on that benefit to the investor. Right. And that's why at the end of the day, you will see superior returns being made by investing into liquid and money market funds compared to similar tenor fixed deposits. More or less that has been a fact for many years now, and one would presume that that would continue to remain going forward. But to answer your question, one would expect that fixed deposit rates would inch up further. In fact, if you actually look at certificate of deposit rates, which are a proxy for wholesale bulk deposits, those rates have risen very smartly in the last few months, because banks have been trying to raise bulk deposits, given the fact that credit growth has been very respectable.
All right. So here, this is the entire story when it comes to your debt investment. But parking in your money, liquid funds give you better post-tax returns. So that is one factor which you should definitely keep in mind. Thank you so much for joining us today, Amit, and explaining us about debt portfolio and the way to go about it.